This is our Forex blog for June 6, 2013, and there's many different ways of trading using our software, but I'm going to teach the easiest, the most predictive, I think the highest winning percentage, the less stressful, the most profitable, the easiest to learn, and the most effective. Any adjective you can use to describe a method of trading, I think this is our best one. Although we have many ways of adding to it with advanced methods like support resistance, Fibonacci, pivots, value profile, market profile analysis, and so forth. Basically, this shows you what every currency is doing, and it gives you a wealth of information. You can see in real time the dollar tried to go up early into the day, could not get over the high of yesterday. In other words, the market was strong earlier, but it wasn't able to go above the highest high the dollar index did yesterday. Same thing here with the yen. And then it broke down underneath its hourly moving average. And once that happens, you want to focus on sells. Some ways of trading each. Basically, what you want to do is you want to find the strongest ones and buy it versus the weak, and vice versa. Once the dollar breaks down underneath here, basically you want to sell pullbacks. And sometimes you don't get pullbacks, but these are areas where I would consider selling the dollar since it's in a downtrend. What currency was strongest earlier? Well, the yen was strong, but then it broke its hourly. The pound has been above its hourly. The CAD above its hourly. The CAD has a weekly trend that's down. The pound doesn't. So I would pick the pound. The Swiss earlier in the day was above the hourly. So once the dollar breaks down, you can sell the dollar Swiss. You can buy the pound dollar from basically 230 onward. And ideally, you find a pullback in one currency, like right here at 4 a.m. approximately, that lines up with this one. Now at 4 a.m., this one's right at its lows. It's maybe not the best trade. 6:30, you have a pullback, and there's a little bit of a pullback in the dollar. So 6:30 is a pretty decent place to look for example, a pullback and buy the pound dollar. Now this one went pretty much straight ballistically up earlier in the day. 6:30 is right here. You had a little bit of a pullback on that. You can see over the next half hour it did go up, made a higher high. A lot of times moves like today where it goes up and it's pretty much sideways and then straight up, there's fewer opportunities. There's two methods that we look for on any individual chart. One is a pullback trade, and really this is the only decent size pullback trade, and it's up statistically so far that it really didn't continue. Most days you have moves up that kind of go like this, where you're making higher highs. You want to buy those pullbacks. Some days, like today, you just basically have rectangle shaped breakouts. But the currency index clearly showed you that was the one you wanted to buy, and right around 10:30, the dollar made new lows, and the pound was already above its high of yesterday all day. And when this thing was breaking down to the downside, you can see the pound's already going up. The euros, or the Swiss, is going up. The euro's going up. You can trade all these strong ones against the dollar at 10 o'clock. So the dollar Swiss is going to go down at 10 o'clock, and you can see from 10 o'clock you actually had a beautiful, nice little pullback right here. Sometimes the pullbacks are very shallow like this and kind of go sideways. You can either get short with your stop above here or wait for it to break the low and put your stop above here. Just astronomical move, obviously down. You couldn't have went wrong today if you sold all the dollar pairs. But the euro dollar, 10 o'clock also, if you look at the chart, it's going up here above. 10 o'clock is a little bit before 10, it had a little flag pattern, broke out. You have a nice little rectangle pattern here. There's kind of a 45-minute flag pattern there. Again, most days you want to kind of wait for pullback trades. Let's scroll back and look at the previous day. Like here you have a big down move, you have a pullback. That's typically what you want to do, is sell the pullback. It makes a lower low, you get a pullback, you sell it. Obviously these are small 10-pip moves, nothing like today's volatility. But pullback trades are one of the higher probability ones. What's also nice about this is you can also see things like double tops and triple tops. The Australian has a very weak weekly monthly trend. It came up here. So when it double tops at that same price, and especially triple tops, fails to make a higher high, these are two great places to sell. 1500, 1700. Which currency is strong at that time? At that time, you can see the Swiss is pretty much above its hourly moving average, sitting at support. So this is likely to go down, and this is likely to go sideways or up. Unfortunately, it didn't really move up. This last move did go up. So selling the Australian Swiss both times, again at 230 and 430, makes sense. Here's 230, we're looking for our first sell in the second trade right here. And you can see, basically, these are times where you start looking at the chart and you're kind of looking to sell breakdown of the up move. The only thing I don't like about these trades is it's above its hourly moving average. But you knew about the likely reversal about 10 to 15 minutes ahead of time, and it did pull back 10 pips. And because you're above the hourly, you might be a little hesitant to get out here. And then it makes a lower low from the previous high. So that's a sign of a downtrend. You go short again right here when it breaks down, and once it breaks its hourly, it just keeps collapsing. You might just, put your initial stop above here. It goes down, it goes sideways. Keep moving your stop down, and then typically, once the market makes a big move, if you draw your fibs off of that move, the fib target down here, especially underneath that lower bands where you get out. But beautiful trade. Let's get rid of all this junk on the chart. Beautiful trade where you risk this amount, and obviously you're never going to catch every pip, but if you did, or even caught the majority of it, you made 4 or 5 times more, up to 8 times more than your risk. And that's really the whole key to trading, and that's why we use our currency indexes. Right now, this is actually a script that I developed. I actually draw these charts myself. This works so well, and it is one of our best features that we're actually putting it in the data feed. So instead of bringing up a saved workspace where I have this set up for you with these indicators on it, you'll be able to actually bring it up on a regular chart and add any of our indicators to this, whether it's linear regression lines, or FX trend candles, or our Spearman indicator, FX trend reversal tool, which shows you when the market's moved too far and it gives you counter trend buy and sell signals. Every one of our indicators, and not just 4 or 5 that I've decided to hard code up on here, will work on it. And it will also be available in the scripting language, so you can develop tools, indicators, and automated systems based on these currency indexes. So as you saw, it's so effective. Just imagine if the Swiss index, for example, is going sideways and it all of a sudden makes a higher high than the last, let's say, 20 bars. Right here would be the case, right? Now let's do it a little bit earlier when it was more significant. The price is underneath the hourly, breaks above the hourly, and makes a new high over the last, let's say, 30 bars. That's a significant event. Which currency is weak at that time? It looks like the CAD's going down, right? So you sell the CAD Swiss at 9 o'clock in the morning. Now, not all these trades are going to work, but the point is, the ones that don't work, you lose 5 to 10 pips. The ones that do work, here's 9 o'clock, for instance. I'm just showing why this is such an amazing thing that we're putting in here. At 9 o'clock, if you see that this one's going down, you might say, I'm going to sell 1 pip underneath this bar's low. All right, well, what does that mean? It means over the next 20 minutes, it's fallen from 90 to 60. That's 30 pips in 10 to 15 minutes. Most traders would be very happy with making 30 pips in 10 or 15 minutes. So if you make 30 to 50 pips when you're right, and you lose 5 to 7 when you're wrong, and you have a lot of break-evens on addition, do you think you'll be profitable trading or not using our currency indexes, either by themselves or in a scripting language where you come up with trading methods off of them? Obviously, it doesn't take a rocket scientist to figure that out. Also, just seeing double tops like that The weekly trend is pretty weak. You draw your trend line underneath those bars high, and you could set an alert on this once we put it in the data feed. And at 8:15, you'd say, all right, the CAD's weak. What is strong at 8:15? The pound looks like the strongest one. The Swiss, the Swiss is weak earlier. At 8:15, you buy the pound CAD. You go bring up that chart. 8:15 pound CAD. You look to buy, and guess what? 8:15 is like right around here. You wait for it to go above that bar's high, and you get this kind of a move. Again, the key to trading is small losses, big wins. You're not always going to catch and have such tiny amount of risk and big profits. But you'll see if you watch our Forex blog for the last 2 months since, or maybe 3 months since we've had the currency indexes, most of the time when one currency is super strong, the other one's super weak, or an event happens that leads you to believe that one currency is going up and the other one's going down, like a double top, double bottom, you tend to get big moves. And in this case, it's 10, 20, 30, 40, 50, 55 to 60 pips up. And that doesn't even count the next move. You know, once you caught that move, you buy the little pullback here and you got another 20 or 30 pips.